Some analysis from 2025 indicate that sustained tariff can reduce US GDP by approximately 1%. By 2028, companies face increase in cost, increased profit margin, and reduced global competitiveness, especially those deeply embedded in global supply chains like manufacturing and technology. Historically, the 2028 and 2029 trade war led to a significant disruption, price increase, and elevated uncertainty, which stalled US business investment and hiring. We saw reports from Federal Reserve about manufacturers facing higher costs and supply disruption. Chinese products in the US also declined significantly, with China seeking alternative market, particularly in Southeast Asia and the Europe areas. So, with all the growing economic impacts, why am I suggesting stocks might not take a massive hit? It all boils down to a few key factors. One of the very first key factors is market memory adaptation. We have seen here before, the market has already experienced a significant trade war. This isn't a completely unknown variable. Businesses have had time to adapt, re-evaluate supply chain, and build in some resilience. While disruption will still occur, the initial stock value is significantly diminishing. Many companies have already diversified their sourcing to explore alternative market. The second factor is discounted expectations. A lot of bad news regarding US-China trade relations is already priced into the market. Investors aren't caught entirely off guard. The expectation of ongoing friction is, to some extent, the default setting now, rather than a sudden unexpected blow. As analysts have been advising investors to be more valuation sensitive and consider diversification strategy, such as a favoring dividend stocks. The third factor is domestic focus resilience. While global trade is crucial, many US companies, especially those in less cyclical services-related sectors, have a significant domestic focus. These businesses may be less directly impacted by tariff fluctuations. Additionally, strong aggregate household companies bank balance sheets in the US suggest a degree of resilience in deep financial crisis led downturn. The fourth factor is targeted tariff loopholes. While headlines scream about sweeping tariff, the reality is often more nuanced. We have seen potential suspension and expectation for certain products and industries. Companies are also adept at finding ways to circumvent tariffs, such as rerouting goods from other countries. For example, Chinese goods reaching the US via Mexico or other Asian nations. This indirect trade can cajole the blow to direct bilateral trade flows. The fifth factor is focusing on specific sectors. Impact of trade isn't uninformed. Industries heavily reliant on global supply chain like electrical equipment, electronics, and transport equipment more valuable. Obviously, sectors like software and services, which are less exposed to trade tariff impacts, might be more resilient. Investors are already rotating into defensive sectors like utilities and healthcare during periods of heightened volatility. Monetary policies and stimulus potentials. Central banks are keenly aware of economic headwinds. Should the trade war genuinely threaten border economic stability, there is always the potential of monetary policy responses, such as interest rate adjustment or other stimulus measures to cajole the blow. For example, Basket Bank analysts noted that China has pushed forward stimulus to counteract the tariff effect. So, what does this mean for you, my audience? Don't panic sell. Knee-jerk reaction rarely pay off. Understand the underlying dynamics and differentiate between headline noise and fundamental impacts. Diversify your portfolios. There is always sound advice, but especially relevant in times of uncertainty. Don't put all the eggs in one basket, particularly sectors heavily exposed to trade disputes. Focus on quality companies. Look for businesses with strong balance sheet, resilient business model, and diversified revenue stream that can weather economic turbulence. Consider long-term trends. While short-term volatility is likely, the long-term growth for trajectory of innovative companies and strong economy often remain intact. The stock market ability to recover after past trade war period. For example, the P&S 500 significant gain in 2029 after a 2028 dip is a statement to this. the re-escalation of the US trade war is certainly a factor to monitor. However, based on my past experience, market adaptation and the targeted nature of some of these measures is not necessarily the death knell of stocks. Market momentum that some might predict. Stay informed, stay diversified, and remember that market opportunities often arise even in challenging environment. What are your thoughts? Let me know in the comment section below, and don't forget to subscribe to this channel for more updates on the US and China trade war and the global market as a whole. See you next time.